Welcome everyone to another edition of Overberg Asset Management review of Q4 2024. With me today, I've got Nick Downing, CEO and Chief Investment Officer at Overberg Asset Management, that will give us a presentation looking back at the last quarter of 24, but also what happened in 2024, and then giving us an outlook for the rest of the year. So just going through the agenda, first up, we'll look at the global economic and market review, so looking back. Next up, economic and market expectations. What can we expect in 2025? Then we're going to have a look at the projected asset class returns for 2025 and 2026. Next up, looking at the OM global portfolios and how we performed in last year, and then summarizing all of that at the end. So without further ado, over to you, Nick.
Welcome everyone, and thank you for the introduction, Carel. So we start off with the global economic and market review. Equity markets continued their strong run during the fourth quarter amid continued economic growth and positive earnings. Central bank easing lent further support to market sentiment. The US economy stood out with 2.8% quarter-on-quarter annualized growth in the latest reported quarter, being Q3. Eurozone growth picked up in Q3 to 0.4% quarter-on-quarter, up from 0.2% in Q2. In China, GDP grew in Q4 by 1.6% quarter-on-quarter and 5.4% year-on-year, the highest recorded since Q1 2023. Central banks normally cut interest rates to avert recession, but this time round, rates were cut despite solid growth. The US Federal Reserve implemented the third rate cut of its easing cycle in December, and accumulated 100 basis points so far. Rate easing cycles have advanced in several developed economies over the past quarter, including Canada, Eurozone, UK, Sweden, and New Zealand. US equity markets were the clear outliers in 2024, despite their significant premium to other markets, benefiting from better earnings prospects and growing enthusiasm for artificial intelligence, AI. While the S&P 500 index climbed 23.3% in 2024, the global benchmark, excluding the US, increased by a comparatively modest 5%, also in US dollar terms. The sustained outperformance of US equities has resulted in their markets accounting for approximately 67% of the global total. This is the highest weighting in over 50 years. Recent dominance is largely due to the technology sector, now comprising a 31% weight in US markets. Indeed, US technology shares comprise 83% of global technology capitalization. More broadly, the US economy has enjoyed greater productivity growth than its peers. In contrast with other economies, US productivity growth has accelerated since the pandemic. Donald Trump's re-election in November added extra fuel to the equity bull market, especially in the US, which will benefit most from his pro-growth reform agenda. His initiatives to cut taxes and deregulate should enhance investment spending and productivity. Notwithstanding the threat of increased tariffs, Trump's economic policy can be likened to the supply-side stimulus successfully implemented by Thatcher and Reagan in the early 1980s, which paved the way for the US and UK economic booms in the 1990s. As a result of continued outperformance, US equity valuations are at decades-high premium to other markets. Since the bull market began in September 2023, the 12-month forward price earnings multiple of US equities has risen from 18 to 23. Over the same period, the global excluding US benchmark has barely budged and is now trading at a historically high 40% discount to US markets. This means the non-US markets are very cheap and contain little downside risk. The all-important 10-year Treasury bond yield increased in 2024 from 3.9% to 4.6%. The increase took place in the fourth quarter when the bond market was rattled by higher than expected inflation data and Trump's pro-growth agenda. As bond yields rise, their prices fall. The bond sell-off was mirrored globally, except for China, which has been dealing with increasingly deflationary forces. The S&P Global Developed Sovereign ex-US Bond Index suffered an 8.1% loss in Q4 and 6.7% loss over the year. Uncertainty over Trump's trade tariffs affected sentiment in non-US equity markets. When Trump began a trade war in his first term in 2018, most equity markets tumbled. Despite the protracted Middle East crisis, the oil price has remained stable, but is at risk of spiking higher and imposing a growth tax on oil importing economies. Ukraine's war with Russia holds the same risk. But as a net energy exporter, the US is in a relatively strong position. Moving on to economic and market expectations looking forwards. We expect above-trend economic growth in 2025, led by the US, with 2% or 2.5% GDP growth. The US economy will be propelled by strong consumer spending, backed by rising real incomes, healthy labor demand, and positive wealth effects. Business investment should pick up in response to ongoing strength in company earnings and a friendly regulatory environment. The economic expansion is expected to broaden globally amid a cyclical upturn in manufacturing and trade. While the pace of interest rate cuts has slowed, they are expected to continue over 2025. The Fed funds rate is forecasted to decline from its current range of 4.25% to 4.5% to 3.5% to 3.75%. Other developed economies, which are not yet growing as convincingly as the US, will likely cut interest rates more aggressively. The ECB's benchmark lending rate is forecast to decline by a further 150 basis points from 3% to 1.5%. The UK base rate by 125 basis points from 4.75 to 3.5%. The exception is Japan, where the Bank of Japan hiked its benchmark rate on the 24th of January, just last week, to 0.5%, its highest in 17 years. The BOJ is forecast to lift the rate to 1% by the end of this year. This chart shows central bank interest rate forecasts over 2025 and 2026. Interest rates are still falling. Easing cycles have advanced, and we expect them to continue over 2025. The Fed's policy meeting, which concluded yesterday, has led us to temper the Fed forecast by 25 basis points from 100 to 75. The widening productivity gap between the US and its global peers is unlikely to peak soon. US research and development expenditure is set to continue its structural rise, now accounting for 3.5% of GDP compared to 2.5% in the mid-1990s, when the internet revolution led a similar productivity boom. Investment in AI, which is accelerating at breakneck speed, provides fertile ground for productivity enhancements. Excuse me, this chart shows productivity growth by region in the world's developed economies. The widening productivity gap between the US and the rest of the world is unlikely to peak soon. Relative GDP and earnings trends have closely tracked relative labor productivity. An expanding productivity gap with the rest of the world reduces the odds of a sustained downturn in US relative earnings growth. S&P 500 earnings are forecast to increase by about 14% per annum in each of the next 2 years, driven by the tech sector, which is expected to grow earnings by over 20% in 2025. US equities are expected to keep outperforming over the next year as enthusiasm about AI continues to increase, potentially fueling a stock market bubble. The valuations of the big tech sectors are still only at levels which followed after the dot-com bubble had all but finished deflating in 2003. There is ample scope for valuations to rise more before the bubble bursts. This chart shows the exceptional increase in US profit margins, the lower line being the aggregate market and the upper line being the technology sector. The outperformance of the US equity market reflects superior profit margin growth. This is especially true of the tech sector. Consensus estimates are for the tech sector to produce earnings growth of 23% in 2025. There are market risks. The downtrend in inflation appears to have stalled in some economies, and fears of tariff hikes and immigration curbs could prompt an inflation scare. However, productivity increases should restore the disinflation trend, and any tariff or immigration-led inflation increases would be once-off. Trump's policies bring both upside and downside risks to the economy. Deregulation and tax cuts are good for growth, but tariffs and curbs to immigration are negative for growth and negative for inflation. Nobody knows for sure what combination of policies will arise or their timing. Markets don't like uncertainty. In all probability, however, Trump will want to maintain economic and market stability. For him, market performance has long been the key measure of his own governing success. Upside risks outweigh downside risks. There is a greater risk that economic growth forecasts will be exceeded. US household balance sheets are in excellent shape, providing substantial capacity for re-leveraging, which would push economic growth above consensus for an extended period. And the rest of the world may recover faster than expected. Aggressive Chinese stimulus or peace breaking out in the Middle East and/or Central Europe could significantly lift growth prospects. This chart shows the premium attributed to US equities versus the rest of the world. The valuations of US equities are quite high versus the rest of the world based on forward price earnings ratios, but they have further to run compared with the dot-com bubble of the late 1990s. This chart shows that US markets have not yet become speculative. Markets are exhibiting consistent discipline, rewarding US equities in proportion to their superior return on capital, ROE. The likelihood of a sudden reversal in US equity market outperformance is indeed low. In this table, we can see the forecasts from Capital Economics independent research company, and it may be worth mentioning at this juncture that Capital Economics forecasts were the most accurate out of any independent macro research company in 2024 and 2023. According to their forecasts, we should expect stock markets to keep making strong gains in 2025, led by the US, as a bubble forms around its tech sector and growing enthusiasm for AI. In 2026, markets may consolidate from what will by then be overvalued levels, with cheaper, more cyclical regions providing a greater margin of safety. Bonds, private credit, and alternative asset classes should come into their own as we move into 2026. And now we turn into the next item on the agenda, OAM's global portfolios and our investment positioning. We remain invested in investment companies. Corporate activity in the investment companies universe has reached record highs, driven by wide discounts, shareholders' focus on scale and trading liquidity, and increased activism and engagement. Increased corporate activity highlights the attractive investment opportunities that are on offer, given the scope for NAV discounts to narrow. OAM is as excited as ever about investment companies and continues to build its global portfolios around these specialist investment vehicles. With 24 years experience, we have become leaders in this unique investment strategy. Among our clients' portfolio holdings, we expect the US-focused investment companies to once again steal the limelight in 2025. Allianz Technology Trust plc will remain the largest holding, with its potential for its portfolio weighting to be increased further. We maintain our strong conviction in the technology sector, which we expect will be the main beneficiary of development and expenditure in AI. We would not rule out a bubble surrounding AI to inflate over the next 12 to 15 months. Allianz Technology is an award-winning investment company managed in Silicon Valley, where many of the world's key technology companies are headquartered. As well as being the biggest portfolio holding, the share was also the top performer in 2024, with a gain of 41.1%. Edinburgh Worldwide Investment Trust plc is another US-focused portfolio holding. The share was added timeously in August last year and was subsequently the top portfolio gainer in the fourth quarter as interest grew in US small cap shares amid prospects for deregulation under a Trump administration. Although invested in a global portfolio of smaller companies, the bulk of its holdings are in the US. US small cap shares are more domestically focused and less susceptible to protectionist policies. With lower economies of scale, they are also likely to benefit more than their larger peers from deregulation. The largest holding, SpaceX, is expected to maintain its strong growth trend. The US is a strong candidate for increased portfolio weighting, given its expected continued outperformance in 2025. Yet, looking further afield and further ahead, US equities are not expected to outperform beyond 2025. As the valuation premium over other markets continues to widen, leadership will eventually shift to non-US markets, including China and the Far East, Japan, Europe, and the UK. These markets, which offer cheap valuations, will come into their own as the global economic cycle broadens. An upturn in global trade, which began in early 2024, should gain momentum. China is likely to grow at slightly above its 4.5% potential growth rate as the drag from the residential market eases and stimulus takes effect. After 2 years of subpar growth, European growth is expected to pick up, led by improved consumer confidence and higher manufacturing volumes. Political sentiment in Europe is poor, but there is scope for positive surprises in both Germany and France. Japan is enjoying a solid rise in earnings, helped by structural reforms and improved corporate governance. Profit margins in Japan are at multi-decade highs. As well as being diversified across regions and currencies, Our clients' portfolios are diversified across asset classes, with exposure to our best ideas in listed equities, private equity, infrastructure, and hedging strategies, bonds, and credit instruments. OAM has a long track record in managing global private share portfolios going back to 2002. £100 invested 22 years ago would now be worth close to £500. It has not been a straight line, but it is not timing the market that compounds investment returns, but staying in the market. The annualized return in pound sterling net of all fees is 7.22% over the past 22 years, and in rand terms, an annualized return of 9.74%. Asset allocation and global allocation is diversified across asset classes, across regions, and across currencies. It is a global, actively managed, multi-asset class portfolio. The balanced portfolio shows a similar trajectory, although due to its lower equity exposure, has a somewhat lower volatility and different endpoints. The annualized return, surprisingly, is in fact slightly above that of the growth portfolio due to unusually strong returns in the bond market in the decade following the 2008-09 global financial crisis. In summary, world growth is being led higher by a strong US economy and a recovery in both global trade and manufacturing cycles. There is a risk of nagging inflation and uncertainty over Trump's policy agenda, but there is a much higher risk of US and global economic growth beating consensus forecasts. Global equities are poised for 15% dollar-based returns this year. After a stellar performance last year, US equity markets are expected to produce another strong showing in 2025. Once US markets reach bubble-like proportions in the next 12 to 15 months, market leadership will shift to cheaper and more cyclical markets. When markets shift, probably in 2026, bond and credit markets and alternative asset classes will come into their own, providing stability to our clients' global portfolios. So now we move to the Q&A discussion, and I think, Carel, you would like to ask some questions about the local markets, which we haven't covered in this presentation.
Yes, thank you for that quite detailed update on the global markets. And just for our listeners, if you have any questions or remarks, please visit our website, overberg.biz, or reach out to us at info@overberg.biz. Nick, so yes, we've covered quite a lot of ground on the global markets. I think it's fair to say that we're quite bullish on the US market. But if we turn our focus now to the local markets, let's chat about the past year. How did the local markets perform in 2024?
So the JSE All-Share Index gained 9.4% for the year, despite a decline in Q4 of 2.8%. And if we look a bit deeper, the Financial 15 Index led those markets, the South African equities, with a 15.3% annual gain, while the Industrial 25 Index followed with 14.4%. The dollar gold price remained close to its Q3 level at year end, closing at $2,624 per ounce, resulting in an impressive annual return of 27.2%.
So Nick, it's often the case that financial markets don't necessarily track the economy. What were the main economic challenges for South Africa last year?
Well, first and foremost, slow economic growth. GDP contracted in the third quarter by 0.3%. And that was largely due to adverse weather affecting agriculture and ongoing issues in mining and manufacturing. And private sector investment also remained weak, although public sector spending showed some improvement. And then there were persistent challenges, including slow structural reforms and logistical bottlenecks.
So not a great year for the South African economy. But if we look towards this year, what are the positive indicators?
Well, absolutely more positive. Business and consumer confidence are both improving. The South African Reserve Bank's interest rate cuts are providing support. Inflation dropped significantly to 2.9% in November. Then S&P Global Ratings upgraded the outlook for South Africa from stable to positive, citing the potential for reforms to lift economic growth. And then we've had a couple of wins over the last quarter, including the formal launch of the National Transmission Company of South Africa, which, although still a wholly owned subsidiary of Eskom, advances key energy reforms. Then the Minister of Home Affairs, he gazetted new visa regulations, which has been one of Project Vulindlela's priorities. Then, last but not least, on the 1st of December last year, South Africa assumed the presidency of the G20 group of nations, offering a valuable platform to promote foreign direct investment into the country. GDP growth is expected to rise steadily, reaching 1.7% in 2025.
So I think quite a lot to look forward to, quite a bit of positive news. What are the key risks to the local markets recovery for 2025?
Yeah, there are, of course, substantial risks, as always. The ones that we've identified are water security and organized crime. And both of these are quite serious. Additionally, the pace of reforms and political stability under the Government of National Unity, the GNU, will be critical. While progress has been made, sustained reform momentum is essential to secure long-term growth.
So finally, we've spoken about the economy, spoken about the risks. What are the opportunities in the local markets for investors?
Really, valuations. So local equities remain undervalued compared to global markets, and also historical levels. Accelerated reforms could boost earnings growth and market valuations. For long-term investors, South Africa presents a compelling opportunity, especially in industries benefiting from improving business confidence and economic reforms.
Thanks for that, Nick. So I think there's quite a lot of optimism for the year ahead, both the global markets and the local markets. Nick, any final thoughts from your side?
I just want to say thank you, Carl, and thank you to all our listeners. Thank you to the support from all our clients over all these many years. And if you can refer our products and services to friends or anyone who you feel might benefit, we would encourage you to do that. They'll be in very good hands. My advice to investors is to stay informed and focus on diversification, and both global and local markets present unique opportunities that are worth exploring.
Thank you, Nick. Some wise words. And thank you to our listeners for giving us the opportunity to inform you and update you. And I will greet you until next quarter. Thank you, Nick. Thank you, listeners.